First of all, I just want to say on behalf of myself and all of my colleagues here, we're just delighted to be here and delighted to have the opportunity to give you our thoughts on the domestic economy. Coffee for us in our banking group is the single largest industry that we finance. So without all of you, we wouldn't have much of a business. So thank you in advance. And I'm going to focus on the domestic U.S. economy because since coffee's traded in dollars, the shape of the U.S. economy is going to really affect exchange rates more than anything else. So I think it's probably fairly relevant to the coffee trade, even if you're not based in the United States or even doing business necessarily in the United States. So the good thing is the economy is in pretty good shape. The last 4 or 5 years we've spoken here, we've had gloomy news. This year, I think things are looking pretty good. The theme is that the U.S. economy has improved. It's in good shape. We think that it's poised for a sustainable recovery, but it's still fragile, and we'll get into that. You can see here, this is just the GDP growth of the U.S., and you can see that red bar, the second one over to the right, was the first quarter of this year 2014. It wasn't the economy contracted by a little over 2% that quarter, and then expanded the following quarter by a bit over 4%. So it wasn't that we actually had a decline in activity, it was a delay, and the reason for that was that it was just an extremely cold winter. So shipments, home starts, all kinds, even shopping, were all delayed. So while the economy is still growing at roughly a pace of about 2% a year, a good, really strong economy doesn't stall because of some cold weather. So that's sort of the consistency in this theme, is that things are still fragile. So there's basically, for an economy to have a sustainable growth, personal consumption needs to be strong. That's what drives the economy. There are two driving forces to personal consumption, which are the housing market and the labor market. For most Americans, the largest single asset that they own is their home. And so if home values are high, they feel wealthier, they're more encouraged to go out and spend money. Similar with the labor market. If the labor market is strong and personal earnings are growing, people feel wealthier, they have more discretionary income, they're going to go out and spend. On the flip side, there's a couple of negative forces, which are deleveraging, meaning saving or paying down debt. If you save $1, that's $1 that you're not spending and putting into the economy to drive personal consumption, and then savings, of course. And those drive GDP. So this is just a chart of the average American household assets over the last 15 years or so. You can see the bottom line is residential real estate. So even though we're not back up to the levels that we were in early 2007, 2006, before the decline in housing prices, the household still makes up about a quarter of the average American's net worth. So the line here, the blue line is the average housing price. The red line is the change in price year over year. So you can see it's pretty deep. When we had the following the credit crisis, had the decline in housing prices. Housing prices are up actually about 11% year to date. So if you look at all the different asset classes, including stocks, bonds, housing has actually been the best performer in the United States. So that's a good thing. We're still not back at the levels that we were at, but we're getting fairly close. The thing that we have to watch, though, is mortgage rates. Even though they've come up a little bit recently, mortgage rates are still at historical lows. And so, of course, if you have a low mortgage rate, your mortgage payments are going to be lower, housing is more affordable, and there's more demand for housing. So what will be interesting is to see, as the Fed starts to raise rates and mortgage rates start to normalize, whether that has a drag on the housing prices or not. So now we'll move on to the labor market. We're now down to 5.9% unemployment, which is a significant improvement, of course, from the 10% that we had 5 or 6 years ago. It's still not good enough, and part of that is we look at unemployment by the statistics that are released by the government. What that doesn't include are people that are underemployed, so someone who maybe wants to work full-time but has only been able to find a part-time job, or people that have just simply given up looking for work and aren't eligible for unemployment anymore, and so they're just not even in the statistics. If you include those classes of people, we're still at around 12% unemployment / underemployment. And so that's 12% of Americans who are making less money than they need to. And as long as that's the case, that's going to be a drag on spending. This is another thing that's very important. This is the average hourly earnings growth. So even though unemployment has been coming down, so more people are working, wages have not been rising. And even when you look at this, you can see wages have been up around, averaging in the last few years, around 2% a year. So it seems like they'd be rising, but this is in nominal numbers. And it doesn't include inflation, which has also been about 2%. So more people are working, but people are not receiving more purchasing power than they had. So that's a statistic that's really going to have to come up in order for the GDP growth in the U.S. to improve more than it has been. I also mentioned that savings is something that detracts from GDP. You can see here, if you look at 1974, which was when the savings rate was the highest, Americans were saving almost 15% of what they were making. Going into the credit crisis, people were saving about 3% of what they were making. Now, the good thing about that is, as you save less, that means you're spending more. That encourages growth in the economy. The bad thing about that is that it leaves, with 3% savings rates, it leaves absolutely no cushion when there is a bump in the road. And so that's why the credit crisis was so tough. There just wasn't a cushion. So saving is generally good for the long run and bad in the short run. So you can see Americans following the credit crisis from 2008 to about 2010 actually started saving again. And they're now loosening their wallets and starting to spend money again, which is a sign that people are confident in that the recovery is here to stay. This is just a chart of the household debt as a percentage of income. And you can see it's basically the exact opposite of saving. People have gotten a lot more comfortable borrowing money and levered up. And since the recession, people have been paying down debt, and that's been a drag on economic recovery. This is a similar chart, but it shows the debt payments and debt obligations as a percentage of disposable income. So it looks like it's gotten really, really significantly better since the credit crisis, but this is highly dependent on interest rates being at almost zero before the credit premiums are put on it. So as the interest rates, as the Fed starts to raise rates, it's going to be difficult for families to keep their debt payments at the levels that they're at right now. This is just a chart of the retail sales and personal consumption. This is what all of those factors kind of blend together and come into. You can see the big dip in 2008. We're not quite back at historical norms in terms of personal spending, but we're getting pretty close. I didn't mention this early, but there's sort of a third negative force, which is energy prices. So even though oil and gasoline prices have come down substantially in the last few weeks, they're still relatively high compared to historical norms, and that kind of acts as a tax on households. If you've got to pay more to heat your home, you got to pay more to drive your car. That's money that you're not going to put into buying clothing and travel and all kinds of stuff like that. So energy prices have also been a bit of a drag. But despite all of these negative forces, we're still growing at 2% per year. So it's not all bad. If any of these start to loosen up, that's gonna really brighten the future. Something that's interesting is in the United States with the advent of horizontal drilling. I don't know how familiar people are with this, but new technology has allowed us to access incredible amounts of oil and natural gas. Oil prices haven't really come down in the United States because the refineries in the U.S. are just simply not set up to use the quality of oils that we have yet, so we're still importing foreign oil. But on natural gas has become incredibly cheap in the United States and is a fraction of what the cost of natural gas is around the rest of the world. What that's doing is actually starting to bring manufacturing back into the United States. And that could be a real competitive advantage for us going forward. So that's something that's really terrific and is going to really help keep things rolling in the right direction. So let's look at corporate earnings, because personal consumption ultimately is going to also drive corporate earnings. You can see here the red was following the credit crisis as the world kind of collapsed. People stopped spending, companies stopped making money. Then what they started doing is just cutting costs. And what that did was create a tremendous rebound in corporate earnings. That's great. But it's not sustainable. You just cannot cut costs forever. At a certain point, there are no more costs to cut. And so you really need a revenue-based increase in earnings. And so that's where personal consumption, of course, comes into play. So at this point, costs have been cut, and it's really revenues that are driving corporate earnings growth. This is just a similar version of the last chart, but it includes a broader sample of companies, not just the S&P 500. One thing that's interesting is, despite the fact that the households in America had been leveraging up and then deleveraging throughout the whole cycle, corporations have just continued to accumulate cash. So there's about $1.6 trillion in cash on U.S. corporate balance sheets right now. That's cash that could be spent once companies start to decide they want to start reinvesting in their businesses. But it's also a nice cushion in case there's a bump in the road, similar to U.S. household saving. What's not great is our government's financial position. Our government has basically done the opposite of what U.S. households have done, and just borrowed and borrowed and borrowed and spent and spent. We now have $17 trillion of debt on the U.S. government's balance sheet. And you can see this, the red line here is our debt, the blue line here is our debt as a percentage of GDP. It's the highest that it's been ever, and at the same time, we're servicing that debt on very low interest rates. So as interest rates come up, which of course the government decides, that is going to put more pressure on our annual budget or our annual deficit, and it's going to be really hard for us to get this number moving in the right direction. This is just a comparison of the United States to some of the other economies around the world. So if you look at, we're on the far right, we're 104% debt to GDP. The only countries that are higher than that are Cyprus, Ireland, Portugal, Italy, and Greece. And those are not countries, even though they're lovely countries, those are not countries that you want to be compared to in terms of economic stability and fiscal condition. So the big question is, what is the Fed going to do? When are we going to increase rates? The Fed's in kind of a unique and frankly a nice position right now, because labor markets are improving and they're heading in the right direction, but at the same time, inflation is completely under control. It's about 2% a year. So the Fed can increase rates, but they don't have to. The market, generally speaking, you can see this is the futures markets that predict what the Fed's going to do. The markets believe, and we tend to agree with them, that the Fed's most likely going to start raising rates around mid-2015. In October, last month of this year, the Fed stopped its quantitative easing and stopped buying treasuries and asset-backed securities. So that part of the Fed's monetary policy has come to an end. This is just a snapshot of the Fed's balance sheet. You can see what it looked like pre-credit crisis. We had about, and if you went back beyond 2007, which is where this chart starts, you could go back 50 years and that line just continues in a straight line. We had about $1 trillion of assets on the Fed's balance sheet. What the Fed did and what quantitative easing has been is they have gone out and bought longer-term securities with the intention of then putting higher demand on those debt securities and thus lowering interest rates. They're now at over $4 trillion on the balance sheet. Since that program has ended, that line now is going to start to just look more like it did in the past. What the Fed will do going forward is they will continue to buy assets, but they will only buy those assets as the current obligations that they have roll off. So it should have a completely neutral effect. And then this is just a shot of inflation, what it's actually been. So it's lately been, for the last few years, pretty consistent at about 2% a year. I think most people would prefer that it be a little bit higher than that, but there really is not a lot of concern at the moment about inflation. And if you look out, you can use the Treasury inflation-protected securities and normal Treasuries and derive what the future expectations for inflation are. It's not in this chart, but the market expects inflation to stay around 2% per year. And so as long as inflation is low, the Fed really doesn't have a lot of urgency to raise rates. So we think when they do start raising them, they're probably going to do it in a very slow and methodical manner. Despite the fact that inflation is relatively low, it's still the biggest threat out there, because if inflation does start coming up, people may remember in the early 80s, it doesn't take a whole lot of inflation to ruin your day. This chart just shows the difference between just money, which has a fixed value, and the actual purchasing power of that money. So if you have $1 million today, you can buy $1 million worth of product. And the higher inflation is, the more that erodes your purchasing power each year of that same amount of money. So if you had 2% inflation, which is what we have right now, over a 25-year period, that would result in a 40% loss of purchasing power. And of course, if you go down to higher rates, it gets even worse. So that's still a huge threat. In terms of performance of the markets, the equity markets have done tremendously well in the United States. They're, if anything, probably becoming slightly overvalued. This just shows the price-earnings ratio going back in time. The average in history is about 15.5%. We're at almost, 15.5 times. We're at almost 18 times now. It's still not overvalued like it was during the tech boom in the late 90s, but the market is certainly fully valued. So it's getting very difficult to find stocks that are attractively priced. And in fact, in our large cap equity strategy, we're holding about 13% cash right now. And it's not because we're looking at the market and just saying, oh, it's overvalued. It's because it's just really hard looking at individual securities to find securities that trade at a discount to what we think their intrinsic value is. Even though the market is fully valued, it's still risky to get out. This chart shows the difference between being in the stock market, dating all the way back to the 20s, and being in the stock market but missing the 5 best days in that period, 5 days. And that if you missed the 5 best days over the last 80 years, you would have a third of the wealth you would have had if you just had been in the market. This is just the way we look at equity investing. It's important to buy stocks at a discount to the intrinsic value. This is why we're holding so much cash, because most stocks are not trading at a discount these days. So then the other sector, so if equities are fully valued, how about fixed income? Fixed income has performed great. As rates come down, the value of bonds go up. There's an inverse relationship between rates and the value. But now we're at a point where rates can't go down any further, and so you take a ton of risk being in any fixed income with any sort of duration, and this sort of highlights it. So this is a difference between the nominal yield curve, and this is just looking at treasuries, so not including risk premiums. But this is the red line is just the nominal yield, which are the rates going out in the future of treasuries. The blue line is the actual real yield, so that's subtracting the 2% inflation that we have right now. So you can see, to even get a positive yield on fixed income or on risk-free fixed income, you have to go out at least 5 years. The further you go out, the more risk you have that as rates come up, it's going to destroy the value of those securities. So it's really tough to find a place that's attractively priced to invest. This is just our analysis of the entire universe of fixed income. We have a team that looks at everything. The blue are names that we think are overvalued and should be sold. The yellow is names that we think are fully valued, and then the green, which is the universe of fixed income instruments that we think are attractively priced, is less than 15% of the total population of debt securities. So it's really hard to find attractively priced securities. We've looked more at alternative investments, and another thing to keep an eye on is if the markets pull out of some of of traditional stocks and bonds, where that liquidity goes. It could go into commodities, which impacts, of course, not just the price of oil and grains, but could impact the price of coffee. And so that's just something to watch. So in summary, we think that things are pretty good, but there's definitely still not much slack. There's not much slack, and there's definitely still some risk in the economy. So I'm going to stop because I think people probably want to eat lunch. If anybody has any questions, I'd be happy to answer them now or after. What? We have time for questions? Okay, I still don't want to keep people from lunch, but anyone have a question? Oh, okay.
Thanks for the information. So I'd like to hear your comments about what is your perspective on the dollar index?
Well, if you look at the growth in the U.S. economy in the last quarter, every single sector, personal spending, business spending, government spending, every sector of the economy grew, with one exception, and that was exports. And the reason for that is the dollar strengthening. And so it's great to have an economy that's doing well, but at the same time, if you have an attractive economy, there's more demand for U.S. dollars to invest in the United States, and that pushes the dollar up, which makes it more difficult for the United States to export. So it's a complicated question because the dollar, there are a lot of different currencies out there. The dollar is not going to move relative to all of them in the same way. But I think that's one thing we have to watch as the dollar strengthens. It's going to be more difficult for the United States to compete on exports. Thank you, guys.